Hello traders, welcome back to my channel. In this video I want to show you how to uh, trade the supply and demand zone. About the video I uploaded yesterday about supply and demand zone, so I want to show you the condition that is needed when trading the supply and demand zone. So I want to show you the condition that is needed to trade such strategy. Okay, so let's go. So as I was talking about how to trade the supply and demand. Okay, so I gave us a sample that when the price is moving up and then break the resistance, reverse at the resistance level and finally break the resistance and again stop exactly at the supply zone. So we should wait for a reversal candlestick to start placing our trade in a downtrend. Okay, so the market structure might not look like this. Most of the time it can look like only this. Most of the time it can look like bullish movement or trend or so many noise, like when the market is forming swing high and swing low. Okay, so then when the price hit the supply zone, they will see reversal candlestick, then we can place our trade on the next direction, which that the market will continue to the downside. Just make sure that the previous trend is downtrend. Same thing applicable to the demand. Okay, same thing. When the price reverse, it creates a support. Then we see the candle cross the supports and then finally hit a strong demand zone. Then that is when the market starts moving upward. Okay, so let's move on. Now, how do you trade this pattern? Like I said, that's how do you trade the supply and demand zone. So once you see the chart, look for a barrel trend, the barrel market structure for bearish or bearish trend, but make sure that the minor trend is bearish. So we are only making use of the minor trend, okay? But make sure that the barrel trend is trending, okay? So the minor trend should be bearish, lower highs and lower low. We all know that. Then look for a supply zone. Then make sure that there's a resistance near the supply zone and price should break the resistance zone. Okay. Then look for a reversal candlestick at the supply zone. So everything I explained yesterday. Same thing applicable to the demand. Look for a barrel trend market structure for bearish or bullish trend. Then the minor trends will be bullish, higher highs and higher low. Okay. Then look for a demand zone. Then make sure that the support near the demand zone and price should break the support zone. Okay, look for a reversal candlestick at the demand, then place your trade. You can place your trade on 1 minute, you can place your trade on 3 minute expiry time, 5 minute expiry time. So now the condition for using this strategy. Okay, this is my best strategy, trading supply and demand. This is my best strategy, trading supply and demand. If you watch the video I uploaded some days ago, maybe some weeks ago, about supply and demand, I use the same strategy. So I use the same strategy on forex. Okay, ask any of my students, I use the same strategy on forex. Maybe I will upload some of our setup on forex, so you see the way I trade supply and demand on forex. Same thing applicable to binary option. Okay, so now how do you trade what are the conditions for using this strategy? Number one, the chart must be trendy. Make sure that the chart is trendy. So when the chart is trendy, we have something like this. This is a downtrend, this is an uptrend, not this. The market here is not trending. So avoid trading ranging. Okay, so avoid trading ranging markets. Okay, this is a downtrend, this is an uptrend, then this is ranging. So avoid trading using this strategy on ranging markets. Okay, so the market will not work on ranging, sorry, the strategy will not work on ranging market. Okay, so the second condition is the price must break any nearest SNR level before SND zone. So the price must break. It's a must that the price should break any SNR level, that is support and resistance. That is the meaning of SNR. Okay. So the price must break. For instance, if you are trading on supply zone, the price must break the the resistance that is near to the supply zone. So the price must break the supply zone, and then you should enter the trade. Okay, it is a must that the price should break the supply zone. Same thing, the demand. The price should break the support zone that is very close to the demand, then you should place your trade. If the price has not yet break the demand, the support, don't trade. Okay, so I'll show you the examples, some of the trade I took. Then second condition, the third condition, avoid low volume price. Avoid low volume price. Okay, avoid low volume price. This is low volume. Okay, we can see the candle is very weak. The candle is very weak. When you check the volume bar also, you will see that the volume bar is weak as well. So the candle is very weak. This is what we call low volume. So when you see weak candle in the market always, the market, most of the time the price is not always in favor to us when you see low volume in the market. Okay, because when you enter a trade here and the market should go more down to become stronger, you will see small red candles and your entry might not be safe in case of any pullback. So avoid trading on low volume. So this is big volume. So once you see the price has so many big volume in the market, you can trade. That is best. This is best for using the supply and demand strategy, trading the supply and demand. Okay. Then the fourth condition is don't use expiry time longer than 5 to 10 minutes. Don't use 40 minutes. Don't use 30 minutes. Don't use 15 minutes. Don't use expiry time. If you are going to use expiry time, more than 1 minute expiry time, don't use the one that is longer than 5 to 10 minutes. Okay, on 1 minute candle, don't use expiry time longer than 5 to 10 minutes. But expiry time lower, sorry, it's not expiry time. Any candle time lower than 1 minute, you can use 2 minute expiry time. I'm still making a mistake here. Any candle time lower than 1 minute, you can make use of 2 minute expiry time or make use of 1 minute expiry time itself. For me, I like the 1 minute expiry time. If I use a 5 second chart, for instance, something like this, if I use 5 second chart, I use a 5 second chart, then my expiry time will be 1 minute or 2 minutes. Mostly I like using 1 minute as my expiry time, okay? Because at least 12 candles should form and that will make the price to be far away from my entry point, okay, on 1 minute. So most of the time, 2 minutes at times, let me say, it's not that safe because most of the time the market might still pull back to form the second trend. So if they pull back before the second trend, it means that maybe you're going to lose or you're going to win. So, but make sure if you have to use 1 minute expiry time, make sure that your 1 minute expiry time is correct. If you have to use 2 minute expiry time, make sure your 2 minute expiry time is correct. Then don't use expiry time longer than 5. If you are to use expiry time, 5 minute expiry time, you start counting from this, 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 and this. Okay, sorry, 5 minutes. 1, 2, 3, 4, 5. Okay, so you start counting from here, then add other 4 minutes to it to make it 5 minutes. Okay, so that it will make use of 5 minutes. If you are to use 10 minute expiry time, most of the time you will see the next market here. Once the price, let's say this is 20, let me show you how to use the expiry time. This is 2010, that is 5 minutes from 26 to 2010, that is 5 minutes. Then 2010 to 2015, that is 10 minutes. So that means if you want to use 10 minute expiry time, make sure that you use the 15 minute expiry time here. Okay, you use the first expiry time here. So That is when you are using 10 minutes. Okay, but if you are using 5 minutes, make use of this. Okay, 5 minute expiry time. If you are using 10 minutes, add this 5 minutes to the number you see here. So if the number you see here exit 10 minutes, don't trade. Okay, so make sure that you see the correct number that is up to 10 minutes here. So don't use expiry time longer than 15 minutes. I will show you why you should not use expiry time longer than 15 minutes. So this is the trade I took some minutes ago before the market got back. Okay, so let's say example I entered the trade here and I use up to 30 minute expiry time. So let's count it. How many can you form? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30. So you can see the problem of using 30-minute expiry time. See the problem of using 30-minute expiry time. So you are not safe. Your entry is not safe. This is when you enter the trade. So it is not safe when because the next demand zone, the market might quickly reach the next demand zone and finally rise. Okay, so that is better. It is better for you to use 5 minute expiry time or 3 minute expiry time. This trade I use 3 minute expiry time. Okay, I use only 3 minute expiry time. So I took so many trades here. So I use 3 minutes, 1, 2, 3. So if we use 5 minutes, let's count it from here. 1, 2, 3, 4, 5. See, you still want the trade. If you use 10 minutes, let's count it. 1, so let's say 6, 7, 8, 9, 10. Still want the trade. Okay. So make use of 5 to 10 minutes, or if you want to make use of 2 minutes at times, is not safe in case of pullback. Okay, let's say for instance you enter the trade here and you enter 2 minutes. So if this one is 1 minute and the second one is 2 minutes, you see the market will still pull back, you will lose the trade. So 2 minutes at times is not safe. So don't use 2 minutes. Even the second trade. So don't use 2 minute expiry time or more than 5 to 10 minutes. So 3 minutes, 5, 4, 7, or any expiry time you want to use, but no more than 5 to 10 minutes or below 3 minutes. Then also about the 5 second charts. If you have to use 5 second chart, because this one I use 5 second charts and I use 1 minute expiry time. So I use 1 minute expiry time, the price still go down. So within 1 minute, the market go down after hitting the resistance. Sorry, after hitting the supply zone. So I use 1 minute expiry time. You can see. So that is why I say don't use expiry time longer than 5 to 10 minutes. Then a 1 minute candle. So if you have to use 5 seconds, 5, 10, 15, 30, you can use expiry time up to 2 minutes. No more than that. Okay, but 1 minute is safer than 2 minutes. So avoid trading when there is so many dojis. That is number 5 rules. Avoid trading when there's so many dojis. So if you see so many dojis in the market, don't trade because by the time you enter the put option and the doji candlestick form, you enter 3 minute expiry time, doji candlestick will just form on the next candle. You see that because there's no sellers to enter, buyers will enter. And if the buyers that's going to trace on the second candle, if sellers should enter, buyers might still enter again. But if sellers will now enter again, it might not come to your entry point, it might not close below your entry point, it might just a little bit close above your entry point because of the doji candlesticks. So first check the charts. If there are so many dojis candlestick, don't trade. Don't trade if there's so many doji candlestick. So avoid the chart that has so many dojis. Then the sixth condition, okay, I think that is the last condition. So these are the trade I took. Okay, this was the analysis I did on USDJPY. So this is the supply zone. This is the resistance I'm talking about. So the price break the resistance and then head toward the supply. So this is the supply because we see a drop after this base. We see a drop. Okay, so that is where the supply started. That is where the sellers enter the market. So we can see that when the price hits a supply, I did not check the chart immediately, so I would have entered the trade once the price hit the supply. So see, but I entered lately, but I still won the trade. So if I should take up to 2 minute expiry time, I might close the trade, but I use 1 minute expiry time. So this is the first trade, and this is after the trade. See the market go down. After the trade, the market go down. Then second trade before. So look at the chart. The chart was forming lower highs and lower low. If you go to the chart, you will see the trend is lower highs and lower low. Okay, so then I look at this consolidation. Then I saw the drop after this consolidation. So I saw the mini support and resistance. This is the support. This is the resistance. This is the supply zone. So I have to wait for the price to reach the supply before I enter the trade. So that was GBP USD. So later, once the price hit the supply, I took the trade on 3 minute expiry time. Okay, if I should took 5 minutes, the market will still go more than, but I just took 3 minute expiry time. See, but my entry is little bit late. I should have entered the trade here. Okay, so the market still go more down. Okay, that was first trade. That was the second trade. Then the third trade is this. I look at the charts. I saw. Then when I saw the market is still going down, I know the market will still go more down because I have some, because there is still some demand around this area. There's demand here, demand here, demand here. So I know the market will still go more than that. Is why I still took a put option for 3 minute expiry time. Okay, I know the market will still go more down because it's not close to the demand zone. So that is the second trade. Then before, this is the that is the third trade. Before I look at the chart, I saw lower highs and lower low. Then I saw resistance level. Then I saw the supply zone. See the drop. Saw the supply zone, the drop. Okay, after this resistance. So this is the supply zone. So I'll wait for the price to reach the supply zone. But let's see what happens next. I almost lost this trade. I almost missed this trade. Then one thing you should know is that I expect the price to go up to hit the supply before I go with sellers. If we see, look at this trade, if you observe this trade, the market did not hit the supply. What happened? A doji candlestick formed. That means that doji candlestick is supposed to be a green candle to reach the supply, but it closed as doji, no sign of buyers. So sellers entered immediately. When I saw the market as already, when I saw the sellers already entered immediately, I look at the second chart, GBP USD. I saw that they are the same. Then I try to place the true trade at the same time. Okay, because they have the same, they are moving the same direction. So when I saw that the candle close as doji, that was after this trade. So when I saw the candle close at doji, I entered the trade. Okay, you can see that the doji is very close to the supply. No, it didn't touch the supply, very close to the supply. So that means this doji is supposed to be a bullish candle to continue, but no sign of buyers, weakness of buyers. So I quickly entered the put option and the market went down. So that is the fifth trade. Okay, let me calculate it again. How many trades? USDJPY, first trade, GBP USD, first and second trade, that is three trades. Then AUD USD fourth trade. Okay, this is the fourth trade. Then I did not screenshot the first trade on the UAUD USD. I did not screenshot it. So this is the fifth trade on AUD USD. Okay, so that is five trades in a row, five ITM in a row. Okay, so I check Euro USD. I didn't see any opportunity on Euro USD. So that is why I skip Euro USD for the moment. So only GBP USD, USD JPY, and AD USD. Okay, so I didn't screenshot the AUD USD first trade. So that is fit. That is five trade. Okay, so you can see that is how you trade the supply and demand. Pay attention. Look at what happened next when I trade the GBP USD. You see the market still went down. Hit the major demand. This is the major demand, but there are some demand here as well. Okay, so the price hit the demand around this area, and what happened? The price still goes up. So if I should now open the trade for 30 minutes, you will see that I will lose once the price reverse. Same thing here. You see the market. Look at the supply zone. The market did not reach the supply. A doji candlestick formed. Instead of reaching the supply, a doji candlestick formed. When I noticed the doji candlestick, I saw red candle next, so I placed put option for 3 minutes. Though I did not screenshot it, it was two trade I took together with GBP and USD. I took two trade at once. So I only screenshot GBP USD first trade. But during the first trade of this, I didn't screenshot it. So I took the trade at the same time. So later I saw the market is still going down. The market has not yet reached the demand zone. So that's why I still go with sellers again for 2 minutes. If I should go with 5 minutes, go with sellers for 5 minutes, you will see 1, 2, 3, 4, 5. You have a nice fall, a nice drop. Okay, because I'm in a haste in case of the market become bad before I start losing some trade. That is why I decided to take 3 minute expiry time. So because I'm in a haste, the market is going to be bad in the next few minutes. Okay, so that's why I took the trade. Then look at the USD JPY. See the market drop. See the market drop. So this is the strategy I use mostly in forex, also in binary option. Okay, I developed this strategy some years ago in binary option. In binary option, I developed this strategy in binary option. So I now decided to uh, look the way it's going to form on forex. But I find it that it's more easier to trade on forex than binary. Okay, because binary most of the time deal with timing. So if your timing is not correct, you might lose the trade. Okay, so follow the conditions before you enter the trade. Don't trade blindly. Okay, don't trade blindly. Follow the conditions, observe the conditions, go through all the conditions, make sure that the condition meet up with your trading strategy you want to use. So in my next video, meet you guys in my next video. So if you like my video, like, share, and subscribe. Thank you.